Okay, how do we exit covered calls? How do we exit covered calls? If you're selling covered calls for income, then you can wait until the premium has matured to over 70%, then buy the close. You could, wait till it gets 70% of your call and then close it by buying back at whatever premium it is. Or you can wait until it's fully matured and you can keep the entire premium. You wait till it matures all the way. If it matures and the price is below that call, then you keep all the money and your shares. If it matures and the price is above your strike, then you still keep the premium and you get the money that it's worth. Okay, so if I sold the 3 strike, right, and I collected $11 in premiums, I'm going to keep that money. And if it gets breached, if the price goes over $3, they're going to pay me $3 per share. Remember, I only paid $250. They're going to pay me $3 per share. So at the end of that trade, for each set of 100, I'm going to get $300 back. I only paid $250. I'm getting $300. So the difference goes in my pocket. If the covered call strike is breached at expiration, the shares will be called away and you'll be given the strike price times 100 for your contract, for each contract you have. There's nothing you need to do. Believe me, when it's all over, the broker gonna come get their stuff and say, let's get you to whosoever they belong to. Because just like you get put the shares in your box, that's because somebody was buying and selling and the trade didn't go your way, so you got put the shares. The same thing happens here. If you've said, I'm willing to sell my call shares or my shares at $3 and it expires and it's past $3, then they're going to say, okay, great, get those over. Thank you. Thank you for your service. And they'll take the shares and give you your money. Nothing for you to do. It happens all on its own. If you're selling covered calls, but you want to keep your shares, I got Apple shares and I'm trying to hold on to them. Well, you can close the covered call at any time by buying to close the trade. You're going to have to pay whatever premium the contract is worth at the time, though. Okay, so if you say, I really want to keep my shares, you got to buy to close. Or you can roll. You can roll a covered call also. You can roll it. You create a rolling order, which basically allows you to roll it out in time and or roll it up to a higher strike. So you can actually keep the same expiration date and roll it up to a higher strike, right? But you may have to pay something, but you shouldn't have to pay the same thing as you would pay if you just closed it out. Or you can roll it out in time. You may have to pay, you may not. It really going to depend on which you pick going forward, if you're trying to hold on to your shares. If the price moves past your covered call strike, you can just close the trade for a loss and enter a higher strike. A rolling is just that. When you roll something, you're basically closing and reopening, but you're closing all at one time. You're doing the whole motion. You're doing one motion at a time, but you really are just closing your current trade and opening another one, but you're doing it all in one motion. You're just not closing, then separately opening again. You're saying, I'll roll it and do it all at one time. That's really all a roll is. It's closing what you got and opening something different. Real quick, I just wanted to come on. This is Arlissa, Educator to Trader. Wanted to come on and tell you and ask you, I guess, to like and subscribe to the channel. If you like the content that I create and I'm, posting regularly, then go ahead and subscribe. That way you won't miss anything and you can be a part of all that we're doing here. I'm a coach to sellers. I'm an option sellers coach. If that's a vein that you don't know anything about or you want to know more about, then go ahead, subscribe and check us out all the time. All right. Thank y'all. I appreciate it.